All right, we're going to talk about stock option compensation. And why do we have it? It gives key employees the option to purchase stock. It gives them upside potential. So it's supposed to align the incentives of management with the stockholders. Um, the evidence I think is mixed, but still seems to support stock options, although there may be some excess risk taking. Um, Anyhow, so there are also benefits for the employee. They don't actually pay any income tax till they exercise the options. All right. So this accounting changed not too long ago. In I guess in academic time, about 10 years ago. So what we want to do is recognize compensation costs under the fair value method. We're going to fair value the options on the grant date. Now, we're not going to actually do that. There are option pricing models that are out there. You might take a finance class where you use those. I'd encourage you to. I think they teach you not only about the practical issues of option pricing, but more broadly speaking, you start to see option risk in a lot of day to day transactions. So they get you to think about risk differently. So I think knowing about options and option pricing models, um, if you end up being in a career involved in risk management, definitely if you're in financial institutions, can be very helpful. Okay, but for our course, you're not even going to see an option pricing model. The value of the option grant will be given to you. All right, so the questions are where are we going to put, how much is the expense going to be, and where are we going to put it? You could ask the same question to a lot of financial accounting, right? So let me see. Let me see if I toggle over to the lecture note. Whoops. If we have that here. Yeah, updated. All right, so um, here's example one where like a lot of my examples, I start with a simple one and then add to it. Here we're going to start with no expired or forfeited options. So this is the regular case. All the options are vested, and then all the vested options are exercised. So what are we talking about with an option grant? I guess I haven't made that clear yet. We have this thing called the service period. This is ends with a vesting date. Here is a grant date. What is being granted is essentially it's a compensation contract related to the stock options. So when it starts, when the contract starts, that's called the grant date. And this last period, call it the exercise period. Okay. And right here is expiration. So if you haven't exercised the options by the expiration date, that's it. Okay. So we're going to be given a fair value of the stock options on the grant date. I keep wanting to touch the screen. It's not a touch screen. We're going to amortize the compensation expense over the service period. So the total fair value of the stock options on the grant date is going to be amortized over the service period. Then if any options are exercised during the exercise period, we record them. And then if any expire, we record that on the date of expiration. One thing we have to be aware of during the service period is we may have to adjust for forfeited options. Okay, because if they're forfeited, we're not going to count them in the expense. All right, in this first case, there is no forfeiture. I see a problem already. Let's see. So this is January 1 of FY1. I'm not quite sure what happened with this particular copy, but this is supposed to be January 1, FY1. We're not going to deal with partial years. They adopted the stock option compensation plan, and it involved 30,000 shares. The options were granted on January 1, FY1, exercisable 2 years, so it's a 2-year service period after the grant date. They expired 6 years from the grant date. So basically, what we have is we have January 1, year 2, and year 3. This is service period right here. Oops. And then we go 3, oops, 4, 5, 6, 1, 2, 3, up, 7, so to 1, 1, and 7 over here. Alright, and here is the exercise period. So they have a 2-year service period, and then they have 4 years to exercise them. Okay. Total fair value of these options on the grant date is $450. So if none of them are forfeited over 2 years, our total compensation expense is going to be $450. So, but it's amortized over 2 years. So what we're going to see is $225 and $225 to compensation expense, and that is the offsetting credit is paid in capital stock options. So what's very interesting here is you have compensation expense, which will reduce stockholders' equity. All right, so expenses are a reduction to stockholders' equity. And then we have an increase to contributed capital. So there's no change in total stockholders' equity. That's a little bit hanky if you ask me. An accounting treatment that has a salary expense that results in no decline in total stockholders' equity. So delta in stockholders' equity equals 0 through here. Okay, now here's an exercise. The strike price is 40. They tell us what the market price is. I mean, we care if we care about what we could have gotten, but from the accounting perspective, we're just going to record the exercise. So the first 20,000 out of 40 are exercised. That's where the 80,000 comes from, or 800,000 comes from. So the executive has to come up with 800,000 cash. I'll just say as a sidebar, don't worry about it. If you're ever asked if you want stock option compensation, the answer is yes. If you're worried about coming up with 800,000, don't. The corporation will often lend you the money to purchase the stock, and they'll use the stock as collateral, which is fine because you're buying it at 40, but the market price is $67. Okay. Now, when we exercise the option, what you have to do is remove the paid-in capital stock options that you recognized up here. As they get exercised, you're going to remove them. So here, the total of those two, let's see if I can squeeze a T account in here. Paid-in capital stock options, we have 450. Okay, now we're removing 20,000 shares. We had 30. That's where the 20,000 over 30,000 or 2/3 comes from. All right, so that's 300,000. In the and then we issue the stock. All right, par value, that's 20,000 shares are issued times $10. And then we plug the 900. This is a plug. Okay. And down here, similarly, still the strike price times 10,000 is 400,000. 450 times 1/3 is 150. Common stock, now it's just 10,000 shares times $10, 100,000, and we plug the 450 here. I do want to point out one thing. Here's kind of what I think is an easier way to do it. You know it's 450,000 to start, and you have 30,000 shares underlying. Okay? So if you take 45 divided by 3, you get it's $15 per option or per share, however you want to look at it. So down here at paid in capital stock options, this 300,000 also equals $15 times 20,000. And this paid in capital stock option here, over here, is $15 times 10,000. Okay? So you can take this number, calculate it on the grant date, and to me, it's a lot easier than using the ratios that your book. That's a even for me, that's a mess. Let me clean that up a little bit. A little easier than the book uses. Okay. Now let's step back, take a look at this big picture. What's happening? All right. I'm looking for my pen. Where are you, pen? He's hiding from me. All right. So we increased stockholders' equity with credits of 1.1 million here. We decreased it with a debit to paid in capital stock options. Right? So we have 1.1 million in credits and 300,000 in debits. That's $800,000 in credits. Well, look at, we have cash of 800,000. That's interesting. This is exactly the way the treatment is constructed. Okay? The total increase over the life of the entire option grant, including the exercise period, the total increase in stockholders' equity will equal the cash received for the exercise of the options. Because what you're going to do is remove this 450,000, so that amount, this is zero, so that amount ends up being a washout no matter what. Okay? So in the first case, you had 300,000 had to come out of this 1.1 million. And then the remainder is just the cash. So it's constructed that way. All right? So over this entire option grant, the change in total, let me scroll up a little bit here. And the change in total stockholders' equity equals the 800,000 plus the 400,000 in cash received equals 1.2 million. Excuse me. All right. So this one went a little long. Let's break out of this and we'll do more on stock option compensation in just a second.